Hello, Hamish here from monline.co.nz. Understanding how your revolving credit works, reducing versus non-reducing, is not that exciting, but I'll try and keep it interesting, okay? Just to recap, why would you use a revolving credit? Well, you can save interest, right? You can park all your credit funds inside a portion of your home loan, and of course the interest is calculated on the daily balance, on the actual balance amount, and you still retain the ability to draw back out to the limit. All right, so we're all on the same page there. Now, non-reducing versus reducing. So non-reducing limit the limit stays the same for a number of years, right? So just to kind of drill down, imagine you kind of go along and you park all your credit funds, and then a little while later, at this point in time here, let's have a look at what this whole thing looks like on your internet banking. So what you might find, imagine your balance is here, so you're paying interest on this portion here, right? So if you open up your internet banking, you would see something like, say, balance 12 grand negative, so I'll put a debit there. You would see limit. Now the limit would stay at 20 grand, right? And available, so imagine this was 20 grand to begin with, and it's still 20 grand now. So available would be the difference, right? So you'd have 8 grand available to draw down if you need to. How does that look compared to a reducing limit? So a reducing limit is a bit different. So a reducing limit it tries to get to zero after, say, 30 years, 25 years, depending on the term of your home loan. Now, how would it look? So let's say a period of time later. So let's say your balance is around here, and a little while later, we open up your internet banking at this point in time. And again, you started at 20K. What might you see? So let's say that at this point, your limit has... So first of all, the limit will only reduce by the amount you would have paid off in principal amounts on a fixed rate home loan. Okay, so you're not losing anything. You're only losing the amount you would have paid off if it was a standard home loan. But if you open up your balance at this point, let's say, same as the previous example, your balance was 12 grand, but it was debit, negative. Now your limit is reducing. So at this point in time, you might see something like, let's say, a 1K reduction. So you might see your limit has now reduced to 19K. And available would be the difference. Okay, so let's say in this example, it will be 7K. Now, it does go down very slowly on a 30-year home loan, right? So, or a 25-year home loan term. So what you might find is that if your repayments was like, let's say, only $200-300 a month, so maybe, it's probably been halfway through the year or maybe later that you've actually lost this amount. But again, you haven't really lost it. It's the amount you would have paid off if it was a standard home loan, because you would be expected to pay off some amount over 30 years. So that is how a reducing revolving credit looks. The limit goes down very slowly, gradually trying to reach zero after many decades. What is the other difference? So one of the key things is currently with most banks, to move amounts into a revolving credit, if it's a reducing revolving credit limit, you don't always require a full application because the exposure to the bank is not more. So what I mean by that is a non-reducing limit. In some ways, it stays like that forever and ever. Well, it doesn't, because it's kind of an interest-only period on that limit. And so usually it has a time expiry. And when that expires, to renew it, some banks can ask for a full application. Whereas with the reducing, you never have to really do that, okay? With a non-reducing, if you don't do an application, when that limit interest-only period expires, that it will just turn into a reducing, okay? And it will generally, most banks will be pretty fair on what term that is, but and sometimes it's a residual term. With some banks, it's actually reverts to like 30 years or something. Now, going back to the reducing revolving credit limit, the beauty of this is that if it matches the same term as your fixed rate home loans, every time the fixed rate comes up for maturity, to move extra limit amounts in here from your fixed rate home loan, it's just a bit faster and easier. Yeah, not all banks have both types. Okay, most banks have reducing and non-reducing, but some banks only have non-reducing, and some banks can only do reducing mostly. So yeah, but anyway, talk to a good financial advisor like ourselves before you decide on what you want to do, and what's, yeah, we can kind of have a think about what's most suitable. Thank you for watching. Yeah, hopefully that's been useful.